All right, we are here today with Jill Burt, who is a mortgage broker. Is that correct?
That's correct.
Okay, great. And so you provide loans to people. So right now, and by the way, I'm in the process of closing on a house. I'll be closing. I was hoping to close on it tomorrow, but we ended up getting pushed back another day. And that's through First Financial Bank. How is what you do as a mortgage broker different than like going to get a loan like at your Bank of America or wherever?
Okay, that's a great question. So, if you go to a direct lender, which is a bank or just a regular mortgage company, then you're just going with a direct lender. If you go with a mortgage broker, such as myself, I'm able to broker the loan to many different companies. So, I'm signed up with like 8 different companies. And if I'm not signed up with somebody, I can look and see if I can get that product.
Right.
And then I find the best rate and the best product, and I submit your loan to that lender.
Okay.
So, I
And
kind
so
of shop it for you.
Okay, gotcha. So like can you do like creative stuff? Like let's say for instance, I wanted to buy a house and it needed $30,000 of repairs. Is there like loans that are like kind of unique like that or is it or you still stay pretty much with what the general financial institutions do?
So most of the lending in mortgages is general and standard, right? There are a million extra products, just like you're talking about with like a rehab loan. So if you
Right.
needed $30,000 to fix a house, you can do that. They are specific and you need to shop for a specific lender that's going to offer those. Not everybody does it because there's a little bit more work and there's a little bit more guidelines. And so if you're not an expert at it or you're not wanting to be an expert, you may not offer that product. But they are definitely out there. And if you're looking for a house and it requires that, it can definitely be done.
Yeah. And so here's your website and you're with Victory Mortgage and let's see here. And so you're the owner and the broker. So like you own your own business, is that right?
That's correct. Yes.
Okay.
So I
Wow.
started in lending in 1998 and I worked for other lenders and other banks. I started in banking in high school when I was 16. I was a bank teller.
Wow.
And so it kind of, that's how I ended up in finance. And then 3.5 years ago, I started my own brokerage. And I really did that to pass on the savings to my clients. When you're working with a big bank or one of these lenders, there's a lot of layers of management and a
Right.
lot of bells and whistles that create a lot of extra cost. And when I would get shopped for rate, I was always losing to brokers. So I started looking at that.
Right.
And brokers, because you don't work for a direct lender, they don't have to pay you a salary. They're not paying brick and mortar for you to be housed in their facility. So it's cheaper. They can give you a cheaper rate than they can give somebody that works for them because you're going to get the client for them. And so I'm able to not have any additional fees and have lower rates and lower costs for my clients. And that's why I did the mortgage brokerage.
Well, Jill, I should have called you before I called First
You should
Financial.
have.
And that's the thing is like, so I have a HELOC, within my business and within my rental properties that I have now. And so it's first through First Financial, and they sort of make you feel like, and they're great people, wonderful people, but like they sort of make you feel like, hey, you do this HELOC with us, you ought to do your permanent financing with us too. And that's, I think, like maybe that's a sales technique or whatever. I don't know. But like for me, I felt like I kind of felt a little obligated to go with them. But that was also like a little bit of an experience because I haven't gotten a loan in a while. We paid off our mortgages and stuff. And so like we haven't done a loan in a while. But is that something you see with other people? Like they feel like, oh, I bank at Bank of America, so thus I must get my loan from Bank of America.
Yes, a lots of people think that, and a lot of people think they're going to have less paperwork if they use somebody where they already bank. And unfortunately, if you go to let's just say Bank of America, if you go to a mortgage person at Bank of America, and let's say all of your assets, all your checking, everything is with Bank of America, they can't pull your bank statements. You still have to send it to them, even though they bank with Bank of America. It sounds easy, but you still have to send them all of your stuff. Even if you've done a loan with them before, they can't access it. They still
Yeah.
need all stuff from you. But I will say this. Sometimes like at those HELOCs, not a lot of banks offer those. And
Yeah.
if they offer, they're a lot of times more difficult to get. You've got to have better credit. You've got to have, some history behind
Right.
you, right?
Right.
But if you do get it, sometimes they do offer better deals because they want all of your business,
Right.
right? So they give you this HELOC. HELOCs are a great way to utilize the capital that you have in equity to buy another property,
Right.
right? Low interest, they're low cost, and it gets your cash out so that you can use that as a down payment to buy another property.
Right.
So it's a great way to do it. You don't have to use them. They cannot capitalize on that and make you use them. However, sometimes they'll make the deal sweet enough where you don't want to go anywhere else.
Right.
If you have a great relationship with the bank, sometimes they will make the deal sweet enough where they keep all of your business in-house. So it's definitely something to look at, but
Yeah.
it's worth shopping as well.
Right. And they, and it's interesting, like to be able to have, like, we have 3 rental properties completely paid off. We have our house here in Trophy Club completely paid off. So we were completely debt free, but I was still amazed at how much paperwork, like they wanted to know that I had cash reserves. They wanted to know what's in your 401k, what's in it. They wanted to know everything. It's amazing to me how much paper, like there's some guy in a room somewhere who is looking at all of this stuff and saying, Brian Simpson is a good or a bad risk. Is it the same with institutions like First Financial as it is with mortgage brokers?
It is the same. So on primary residences, it's a very highly regulated across the board. If you're a primary residence, because the government wants to make sure that your homestead is covered, that nobody's going to try to take it, because there are a lot of scams out there where people are trying to get you to do something and, use your house as collateral, and it's high interest rate, and they're going to do a
Right.
rehab on your house, and it's a scam. So you really need to really watch for those. There are some bad people out there that look for that. I mean, you guys are in this money class. You're not going to be those people they're preying on, but those things do happen.
Yeah.
But as far as the regularization, it's standard across the board. So whether you're doing an FHA loan, a VA loan, or a conventional loan, which is Fannie or Freddie, the standards are the same. Now, different institutions have what they call overlays. So they may say, you know what, the last, I don't know, 100,000 deals we did, if the customer had, 3 rental properties, then we noticed that they were more likely to default. So they may have an overlay built in there for anybody that has more than 3 properties, they have extra underwriting. So the
Right.
underwriter pulls something, right?
Okay.
Because everything goes through an automated system, and that automated system is going to give us our conditions. It's going to tell us what all is required for you. It's reading you as the borrower. It's going to read your social. It's going to read your credit. It's going to read your income. It's going to read your assets. So
Yeah.
all those things. So like, let's say, for instance, you have $100,000 in the bank, but let's say you've got 500,000 in 401k. You might only give me your 100,000, and I might only need 50,000 for the transaction. But if you give me your 401k, that shows what's called reserves. It shows that you have all this extra money. Well, that makes you a stronger borrower because everything is risk-based. So
Right.
even though you only need 50, if you show me 500,000, you're looking a lot stronger than somebody that only has 50,000 in the bank, or even
Yeah.
if you only have 100.
Right.
So everything's based on risk. So they're looking at credit, they're looking at income, they're looking at your debt ratios. They're looking at all the different things to figure out if you're a good person, because a good person to borrow that money because they want the money back. At the end of the day, they don't want to own your house. It costs too much to foreclose. They do
Right.
not want to do that.
So they're essentially like they're essentially asking for all these things from me to it's kind of annoying, but like they're like literally trying to make me eat broccoli. This is good for you. If you can show us these things, it's going to be good for you. You're going to get a better rate, all of that kind of stuff, right?
It's good for them, and it's good for you, and it's also good for them because the loans have to be able to be sold on the secondary market. So a lot of mortgage companies don't service their loans.
Mm.
And even if they do, they might sell them. If they get like enough loans on their books, then they may sell like a block of loans for like $1 billion. So they take a pool of $1 billion worth of loans, and they sell them to another loan servicer. Well, when loans are sold, there's all these like auditors that go in and look at files. So they may pull, 10 files out of 100 and look at those.
Yeah.
In those files, if there's something missing, and it could be, we missed a pay stub. The pay stub we have is, 60 days old, and we need one within the last 30 days.
Mm.
If those guidelines aren't met, the loan becomes unsellable. And
Okay.
when the loan's unsellable, the lender loses money. So
Yeah.
instead of the lender making money, then your loan is at a cost and they lose money. So they make you provide all that to cover their butt as well as cover
Right.
yours.
They're going to cross their T's, dot their I's. Now, it's interesting that back when I lived in a little house in Red Oak, and it was about, I don't know, 1,200 square feet, but all my rental properties were, 1,600 to 1,800 square feet. So they were much bigger. And when I went to go buy my house in Red Oak, because it's so small, the bank literally wanted a letter to say why I was living in the smallest of my houses like that. Like they thought I was scamming to like try to get an owner occupied loan as well. So it's interesting, all of the underwriting things here. But one of the things you have listed on here, which is fixed versus arms. I have like post traumatic stress from arms because I bought my properties in 2002 through 2004, and they were all on these adjustable rate mortgages. And by the
Yeah.
time they came due in 2007, 2008, 2009, they had gone from like a monthly payment of like 900 to like a monthly payment of like 1300. And I was like, oh my goodness, I'm so thankful I had a sports camp business, because at the time I could take that money and go refinance these things into fixed loans. And from there on out, I was like, I will never do an arm again. Am I wrong? Should we be scared of arms, or is there something to arms that I don't know?
It needs to make sense for the person. Right now, I will tell you that arms, when people ask me about them, I just looked at one this morning. If you're not in the jumbo category, they don't make sense. Like the investors are not pricing them out to make them sexy for borrowers that are just in the normal loan range.
Yeah.
So anything over 726,200 is going to be considered jumbo as of 2023. It
Okay.
changes every year. So next year it might be higher, but this year it's 726,200. Sorry, my dog keeps wanting out. So if you're in that category right now, jumbos are a better deal. Okay. The rates are lower on them. And right now, fixed rates on jumbo loans are not good.
Yeah.
And it has to do with the market right now and with rates going up, and they look at risk levels. And right now, obviously, if you've got $1 million loan versus a 500,000, there's a lot more risk because it's double the
Right.
money.
Right.
And so anytime you're in the jumbo category, which jumbo borrowers are also more savvy, they manage their money. They usually have more money in savings so that if something changes. So the arms that most people are doing right now are, they do not adjust every 6 months. They're fixed for a certain amount of years. So like there's like a 5-6 arm, a 7-6, a 10-6, which that means that for the first 5 years, it's fixed. For the first 7 years or 10 years, it's fixed. And then it starts adjusting every 6 months. The first adjustment is usually like 2%. Some of them, I think on the 10-year, the first adjustment can be a whole 5%. So if your rate is 5% now, the first adjustment period on the 121st month, so right after 10 years, you're going to go up to possibly 10%.
Oh,
Now, it's going to be based on what the rates are at that time.
right.
Um,
Which could be
but
better, which could be way better, you know?
could be, right. But at that point, right, you start watching. So, before your loan starts adjusting, you're going to start watching the market, and you got to know you got to refinance,
Yeah.
but you got to be in a position to refinance
Okay.
because you got
So
to qualify.
So we talk in my class a lot about my students when they're 23 and they get out of college and they got that piece of paper that shows that they've got their degree and all of that kind of stuff, to be in a position to be able to buy a house and be able to build equity rather quickly. And we talked before this a little bit about credit cards, and I'm scared to death of credit cards. And I have PTSD about credit cards as well. And it was, my very first semester, I'm at college, I'm down, I'm in San Diego, and I'm like, yay. And I'm walking down and they offer me a king size Reese's peanut butter cup if I fill out a credit card application. And I was like, heck yeah, I don't know what this means, I'm signing up for, but I sign up for it. I get a credit limit of $3,000. Trips to LA, trips around San Diego,
Yeah.
we went to Planet Hollywood. We lived it up. And it was like, before I knew it, that thing was completely maxed. And I was going like, oh no, what am I going to do? Credit cards, I feel like, are like playing with a rattlesnake to some degree. Like, you leave it over there and you're very cautious around it, you're probably going to be okay. But the moment you start using it a lot, especially as a college student with no really income coming in, it could potentially bite you. Do you agree about credit cards, or do you see that differently?
I do. I think you got to be really cautious with it, because I did the same thing as you. I did
Yeah.
the exact same thing, and it got out of control real fast. And then I'm like, wait, payment? I have no money.
Right.
Um, So you guys will get so many people trying to give you credit, because as soon as you turn 18, you're in the system and they start sending you offers. So
Right.
credit is a good thing. And I will say that credit cards, which is revolving debt, it gives you the biggest lift in credit score. However, you got to manage it. You got to do it. You got to manage it. You got to manage it. And if you can't manage it, don't do it. Wait until you're responsible enough to make that payment. If you're somebody that saves your money and you watch your pennies and you know exactly how much money's in your account, you're probably ready for a credit card.
Okay.
And here's the thing to know about credit cards. It's not just use them and pay them off every month. A lot of people will tell you that. In order for the credits to give you really good scores, you need to let a little bit of balance ride. Now, what does that mean? Let's say you get a credit card. Let's say you get a secure credit card. That means that you're using your own money and they're reporting it to the bureau, and that's how you're getting a credit score. Okay,
Okay.
so I do encourage you to start off with that. Typically, they'll give you like a $300 credit card, but you give them $300, so it's your money. It's basically like a savings account, right?
Yeah.
So as soon as you get that, you're going to want to use it. But I'm talking like $50 or less. So if you're going to drive through Chick-fil-A, buy Chick-fil-A. Get a tank of gas. One thing for the whole month. When you get your bill, and let's say the bill's $50, don't pay all 50. Pay $40, leave $10 on there till next month. Next month, use it again for one more thing, one more Chick-fil-A,
Why does
one
it
more
do
tank of
this?
gas.
It feels like they're trying so hard to like help you. Like we want to elevate your credit, so we want you to don't go and pick the rattlesnake up. Just kind of poke it with a
Play
stick.
with
And
it.
it's like and it's
Exactly.
like I mean that it's just like that's scary. It's like it's gonna get you. Do you feel like that, or do you feel like you know what?
It can if you don't manage it. If you see yourself starting to use it and thinking, well, I don't really have the money in my account, but I really want to go to Starbucks, don't do it. You
Okay,
better have the money in your account before you ever go to Starbucks. Be
right.
smart. Don't buy things that you don't have the money to pay for today. Even if you use it for a credit card, you're only using that credit card to build your credit score. You're doing it,
But it
you're
feels
playing
like a
with that
rig.
rattlesnake.
It feels like a rigged system. I mean, like I took my family to New York back in December, and it's like these banks, these institutions are like have these massive pillars, and they're doing so well because they create these rules where it's like, well,
Mhm.
don't pay it off, have a little bit on there, and it's like they're just kind of getting you closer to get bit all the time, which it leads me to think like, gosh, that's why Americans have such a hard time with credit is because we get into it thinking I'm going to get rewards or I'm going to get this or I'm going to get that. I'm going to build my credit. And it's like, they just kind of, it's like you're in this sinking sand, and it's so hard because your friends are going to Chick-fil-A and you don't have money to go and you want to go be part of it. And you're like, oh, I'll just get an iced tea. And then you get there and you're like, get a sandwich, get some fries. And before you know it, you've swiped away because you don't want to be missing out on it or whatever.
Mhm.
It just feels like, I don't know. I warn my students so much about the trap of credit cards just because there are so many of our friends and people we know have just
That's
been
right.
financially destroyed by them that like to have a rule or to have a system where if you keep a balance just a little bit it's going to reward you, man. That just
It
that was
it's
kind of
wrong.
bad, doesn't it?
I'm waiting for a class action lawsuit against the credit bureaus because
Yes.
after it, we have no real control of our credit. I mean, yeah, can you see it now? And can I send you information for how to get a copy of your free report and get scores? Sure. But what happens when you see something on your credit that's not right? Not only, okay, so it's not only how you're paying your credit cards, they've got where you work, they've got how much money you make, they've got your addresses, and sometimes it's really old data and really old information. What
Yeah,
control do you have over that?
right.
Not much, do you? Because
Yeah.
I do it every day and I don't even have that much control. The other thing is get Credit Karma. Credit Karma, it's not going to give you the same credit scores as like a mortgage credit pool because if it's revolving installment or mortgage, each of those are different credit pools.
Okay.
However, you can kind of watch and see what happens with your credit. You can see if you like start charging on a credit card, your score will start going down. As soon as you make the payment, your score will go back up. So
Hmm.
you can kind of see it, you can kind of watch it and play with it. Now, of course, this is if you are managing your credit,
Right, right.
because I'm going with Mr. Simpson here. If you guys aren't in a place to do it, don't do it. It is a trap. It is a rattlesnake that can get real ugly real fast. And once you get in that, it's like a snowball and people can't get out of it because they start charging you interest and they start charging you fees.
Right.
And the next thing
Fees,
you
yeah.
know,
Yeah.
Chick-fil-A that just cost $10, you're paying $30 for that chicken sandwich. Is it
Right,
worth it? Probably
right.
not.
Right. So let's say for instance I've got the student in my classroom and they're great. Their parents have put them on their credit card and they're getting that credit history built. They're doing all the right things. They're going to college. They're now like they're about to get their degree. What do they need to do to prepare themselves to, let's say they graduate and they get a job that pays them 80,000 a year. Okay. What do they need to do? What would be your advice to help them buy their first house to start building equity very quickly?
So I think you should buy a house as soon as you can because you're going to pay rent to somebody. So you might as well be building equity for yourself. So I want to start by saying that. So I bought my first house at 21. So I would say
Yay!
do it. And I bought my second at 23. So you
Yes.
can do it. It can happen. And if you need down payment assistance, there are programs. Use them. Okay.
So like
Because
it's
if
this is
what
like you don't even have to have a down payment, like or like a
that's
very low
correct.
down payment. Okay.
That's correct. Now, nothing is for free. If it sounds too good to be true, there's a catch. Now, here's the deal with down payment assistance. The rate's going to be a little bit higher, and the fees may be a little bit higher than you would pay on a traditional mortgage,
Yeah.
but it's still worth it. It's still way better than not buying right now.
Right.
And if you look at numbers, like a lot of people, so I do first time home buyer classes, and a lot of people here, I got to put down 20%. So they come out of college and they start saving $500 a month to get to that 20%. We start looking at those numbers. How long is it going to take you to get there? Let's look at how much equity you would have built if you went
Right.
in with 3% down, because you can
Right.
go in with as little as 3%. And that's with no down payment assistance, right? Or you can get down payment assistance and get in with zero. And the way you get in with zero, let's say you get down payment assistance, you ask the seller to pay closing cost.
Okay.
Because not only do you have down payment of at least 3%, you've got closing cost, but you can roll that in. So like, let's say the house costs 300. Let's say your closing costs are 5,000. You can say, look, seller, I'll give you 305. I want you to pay 5,000 in closing cost.
Mhm.
And then you just rolled 5,000 in. The only thing that has to work with that, the house has to appraise for 305 because the lender's always going to lend off sales price or appraised
Right.
value, whichever's lower.
Right.
But typically, a little bit of money like that, you can make it happen,
Yeah.
right? So you can get in with literally like no money down.
Yeah.
And then you start building equity because while you're building equity, instead of saving 20%, the value of your house is increasing.
Right.
It might take you
Appreciation.
5 years to save. That same house you were going to buy for 300 is now 500.
Mm.
You just lost 200,000 in equity
Right. Right.
for waiting.
Right. Yeah. And that's and so you bought your first house at 21. I did I bought my first house when I was 27. I got into the game. I had student loans, I had credit cards to pay off. I released a car. I just did a bunch of stuff where I'm like, and so by the time I was 27, I was able to get out of Huntington Beach, California and come to Texas where you could buy a house for 100 grand, and I could do it. And by the way, my loans, I think were 103% loans. I think the seller paid the closing costs
Yeah.
and they gave me back $3,000 at closing. So literally, I had nothing out of my pocket. In fact, I had a couple $1,000 to go buy furniture for my house as well. But a lot of people don't know that. So you bought a house when you were 21, and you were telling me about your daughter bought a place in Austin. Is that right?
Yeah. So a few years ago on her 25th birthday, we hired a realtor. And I'll tell you this, when you guys talk to realtors, talk to them about deals, right? And also know that they're professionals and their time is valuable. So I'm not saying that don't expect to pay commission because that's how they get paid. They don't work for free either, right?
Right.
But this particular deal was down in Austin. She lived down there. She was working. Here's another thing to know. When you come out of college, you do not need a 2-year work history in your line of work to qualify. Your
Okay.
school counts. So you
Really?
can
Okay.
start one day, you can get a job offer and we know how much money you're going to make and we can close off of that income.
Really?
Okay.
That's incredible. Okay.
So that's really important to know. So she had a job. The other thing is we're pretty lenient on debt ratios. So you will qualify for way more than you want to pay in a mortgage payment.
Right. Right.
Okay. So, and they do that because like, let's say you're married. Let's say your wife has terrible credit, but you have good credit. I'm going to take your wife off the loan. I'm going to use your credit, but your wife's making income. So I'm not using her income because I'm not using her credit. So that's why they give really lenient debt ratios. Okay. So my daughter qualified with her debt ratio. We got our down payment assistance. We looked at like 3 older houses in Austin, and she was a single 25-year-old, and these houses were old. They were going to need work. I'm looking at that toilet going, man, back up the middle of the night. What is she going to do? Right. It's going to be a problem.
Right.
So then he showed us a new house, but the new house was a townhouse and it was far out. It wasn't in Austin proper. And she really wanted to be in Austin, blah, blah, blah. So we got online that night and I looked up that builder because she liked that townhouse. And we found a location in Austin that was where she wanted to be. We drove there the next day. And remember, the realtor had showed us only 3 houses. Okay. So we spent like an hour and a half with this guy. We went to this builder. There was a line outside the door. There was not even a model home done, and the
Wow.
whole community was sold out. This
Oh,
lady had lifted her deposit. There was one house available and there was a lady in line waiting for us. So we wrote the contract right then.
wow.
We ask for, and this is another thing, if you go into new construction, you can also ask for seller incentives and they can help with those down payment or closing cost.
Yeah.
We called the realtor, we asked him to give back 1% of his commission. And then anyway, with his 1% in commission and her down payment assistance, she bought a $330,000 condo and she got in for $350.
Wow. And she
So
she
she
brought
got
in and she brought in roommates, right?
She did, and that helped her. So her mortgage it was around, I think, like 2,500 a month. So
Huh?
that was she was only wanting to spend about 1,200, right?
Oh, gosh,
So
yeah.
she got, even though she could qualify, she was like, man, I can afford it, but I do not want a $2,500 a month mortgage.
Yeah.
So she had 2 rooms upstairs. She leased out both bedrooms upstairs for about $1,000 a month.
Right.
And so her mortgage was almost paid for. So
Wow.
then it was less than her $1,200 a month because the roommates
But
were
was
paying
she
it.
okay with having people living in her house that maybe did she know them or was it like just
She
random
didn't.
people?
She found them online, and actually she did a better job with that. Here's another thing about being a landlord. If they're your friends, they're your friends. It's really hard to say, hey, you know what? It's the first of the month. You don't have rent. I'm going to charge you $30 a day late fee. And if I'm going to serve you an eviction notice by the end of the month. Because if you have roommates, guys, you're landlords. And
Yeah.
there is a squatting thing. And you better have a lease agreement and you better set it up right, because if they don't want to move out, now you can try to manage them out and make them miserable so that they leave. But if somebody really doesn't want to leave, you have to literally serve them papers and
Right.
evict them from your property, which
Yeah.
costs money.
You're evicting them on Wednesday and you want to go hang out with them at the bars on Friday. You're like, that doesn't really work with your friends.
Right.
So yeah.
Yeah.
Okay. And so she gets the roommates in there and then you told me she moved out of the property and now it's an Airbnb. Is that right?
Yes. So now she has moved in with her boyfriend. They're engaged. And so they've turned this into an Airbnb because it is in Austin. It's
Yeah.
fairly close to downtown. And so they can make more money doing short-term lease than they can long-term.
Yeah.
So they're working on that right now. So they've been doing it for a little over a month, and they've been doing the cleaning between the people themselves, and they're kind of
Wow.
figuring that
Okay.
out and seeing if it's
Yeah.
worth it.
Good for
But
them.
that you can make more money short term, but it's more work because
Yeah.
you're not cleaning it once a year, you're cleaning it every single time somebody moves out.
Okay.
Uh,
So we've got about 2 minutes left before the recording is going to cut us off here. So let's say my student gets out of college, they get their first house. You recommend get to their second house. I've talked about this with them as well. How do they do that?
So turn that first house into an investment. You get to keep that primary interest rate. So their interest rate on a primary house versus an investment is way, way, way better. Okay.
Mhm.
Plus you can get in for 3% down or down payment assistance, where if you buy it as an investment property, you're going to have to put at least 15% down. And the rate doesn't get pretty decent until you put 25% down.
Yeah.
Okay. So if you can buy it, so once you buy your first one, then you live in that, and then you're going to turn that one into an investment. So you're going to save up another 3%, or I'm sorry, 3.5 for FHA. Or if you've already bought a house, the second time you got to put 5% down.
Okay.
Okay. So you're going to save 3.5 to 5%. And then you're going to turn your first one into an investment property. And then you're going to buy another one as a primary. So you get the best rate.
Owner occupied loan.
That's
Yeah.
right.
I mean, and that's what we've talked, and then you just keep doing it over and over again until you have enough houses there.
Yep.
I know I preach this to my students, but I don't know if they always, I didn't know that I knew all the right information either. I thought maybe in your second or third home, you had to have 20% down. You're saying they can get into their second, third, fourth, they can get into all those homes at 5% down. So if it's a $200,000 house, they got to save 10 grand over a couple years. That's
Yeah.
totally doable.
And
Wow.
a lot of times you can get that equity out of your primary by doing a HELOC.
Right.
There's other ways to get that money if you don't have it,
Well,
right?
Jill, I appreciate your time so much. You have been fantastic.
Thank you.
Thank you so much for all this great information. And come back and see us again. I've got more. I've got a whole line of questions here for you. I want to ask you more.
Fantastic. Anytime. Thank you, Brian.